Michael Burry, a renowned figure in the world of finance, has a track record of making bold economic predictions that end up being remarkably accurate. He's not afraid to put his reputation on the line, as evidenced by his history of forecasting events that many thought were impossible. For instance, in 2006 and 2007, he was laughed at by investors as he predicted the failure of the U.S. housing market. However, he proved his doubters wrong in 2008. More recently, in February 2021, Burry predicted a massive surge of inflation in the United States at a time when the latest reported inflation rate was less than 2%. Many people doubted his prediction, but fast forward to today and it's clear that he was correct once again. In June 2021, he made another striking prediction that we were in the midst of the greatest speculative bubble of all time, encompassing all things from stocks to cryptocurrencies. Despite skepticism from some quarters, Burry's forecast proved prescient as both stocks and cryptocurrencies experienced a significant crash through 2022. It's rare to find someone who can consistently forecast market movements with such accuracy, and his insight can provide valuable guidance for those looking to navigate the complex world of finance. In September of 2022, Michael Burry accurately predicted a white-collar-led recession. The current massive layoffs across the tech sector are a testament to his forecasting abilities. With a track record like that, it's hard not to pay attention when he makes a big, bold prediction, and his latest forecast for 2023 is no exception. If he's correct, the economic implications could be massive. So what is Michael Burry's outlook for the stock market in 2023? Well, let's just say it's worth paying attention to. Despite his controversial Twitter presence, Burry has been consistently sharing his insights and opinions, and interestingly, he's been leaving his tweets up for all to see. On January 2nd, Burry updated us with his thoughts on the economic environment. Based on his analysis, it's clear that he sees some big changes on the horizon. Over the next few years, we will undoubtedly witness some significant changes, and as the renowned investor Michael Burry has predicted, there are some critical factors that must be considered. According to him, while inflation may have peaked, it is far from over. In fact, he has even gone so far as to suggest that we could see CPI lower and even possibly negative in the second half of 2023, with the U.S. inevitably sliding into recession. Burry's prediction is based on the belief that the Federal Reserve will cut interest rates, leading the government to stimulate the economy by printing more money, thus triggering another wave of inflation. While Burry's predictions may seem alarming, they are based on a sound understanding of economic cycles and historical data. We may see several more waves of inflation in the coming years. This is precisely why the Federal Reserve needs to take decisive action to keep rates high, even if it means risking a recession. Crushing inflation once and for all is the only way to prevent the scenario that occurred back in the 1970s. The current situation is the result of a combination of supply chain issues and excessive money printing, leading to inflation reaching its highest level in 40 years. The Federal Reserve has taken necessary measures to raise interest rates and limit access to borrowed funds for both citizens and businesses. While this may cause some temporary financial strain, it is a crucial step toward preventing runaway inflation that can make goods and services unaffordable for everyone. The Federal Reserve is doing what is necessary to ensure long-term economic stability. By slowing down the economy now, we can prevent more severe economic downturns in the future. Inflation can be a vicious cycle that only worsens with time if not properly addressed. We saw this happen in 2022 when the Fed made the tough decision to raise rates from effectively 0 to about 4.5%. And it worked. Inflation is now trending down. While interest rates aren't super high at the moment, they are predicted to continue rising throughout 2023. That means that debts like mortgages and personal loans will eat up more and more of people's disposable income, leaving them with less money to spend on the things they enjoy. Of course, it's not a popular decision to keep interest rates high for an extended period of time, but sometimes tough decisions have to be made in order to keep the economy on track. And the fact is that raising interest rates is one of the most effective tools. Lowering interest rates may seem like a popular solution to boost economic growth and make people happy, but we must not ignore the potential consequences. The 1970s serve as a stark reminder of the dangers of prematurely lowering interest rates to appease political pressure. Inflation skyrocketed from 5% to 11% in 1974 after the Federal Reserve lowered interest rates, and again from 6% to 14% in 1980. It took a bold move from Paul Volcker to raise interest rates to 20% and send the U.S. into a recession to finally conquer inflation. The chair of the Federal Reserve is nominated by the president, but we cannot let political pressure dictate monetary policy. We must trust in the expertise and experience of our monetary policymakers to make the right decisions for the greater good. According to Burry, we have not learned our lesson and history is about to repeat itself. He is predicting that inflation will settle down, but rates will remain high, resulting in a recession that will cause immense suffering for people. As a result, politicians will put pressure on the Federal Reserve to lower interest rates and stimulate the economy, leading to another wave of inflation. You might think that Burry is just a pessimist with an overly bold prediction. However, it's worth noting that he isn't alone in his concerns. The legendary super investor Charlie Munger shares the same opinion as Burry. Munger believes that the Federal Reserve's efforts will not be strong enough to control inflation. During the devastating recession of the 1970s that lasted for an extended period, the prime rate hit 20% and the government was paying 15% on its bonds. Many people suffered from this recession. While Volcker was successful in controlling inflation during that time, the conditions that allowed him to do so without interference from politicians were unique. Looking back at history, we can see that having a strong leader like Volcker took tough measures to combat inflation in the 1970s. However, in today's political climate, it's hard to say whether our modern politicians would have the same courage to do so. This could lead to new economic troubles that are different from what we've seen before. It's interesting to note that both Charlie Munger and Michael Burry share this line of thinking. They believe that the political climate that allowed for Volcker's success may not exist today. It's possible that we could face even greater economic challenges than those faced by Volcker. The Federal Reserve has stated numerous times that they are committed to preventing an inflationary cycle from occurring. Jerome Powell, the chairman of the Federal Reserve, has recently made it clear that the Fed is committed to preventing a repeat of the inflation cycles of the 1970s. In a recent FOMC press conference, Powell highlighted the Fed's responsibility for ensuring price stability, which serves as the foundation of our economy. He emphasized that the Fed has raised the policy interest rate by 0.5 percentage point and plans to continue with ongoing increases to attain a monetary policy stance that will return inflation to 2% over time. Powell and his colleagues are acutely aware of the significant hardships that high inflation can impose on individuals and families, especially those who are least able to meet the higher costs of essentials like food, housing, and transportation. That's why the Fed is committed to staying the course until the job is done. As Powell stated, the historical record cautions strongly against prematurely loosening policy, and the Fed will not make that mistake again. The Federal Reserve has taken note of the mistakes made during the 1970s and assures us that they are dedicated to preventing history from repeating itself. However, it's worth considering the options of experts like Michael Burry, as the concerns are still valid. While the Federal Reserve may make promises, it's essential to question whether they will follow through on them. Both Charlie Munger and Michael Burry share the view that simply wanting to lower inflation from 2 to 3% is not enough. It's critical to avoid causing a recession by repeatedly increasing interest rates, which can lead to job losses and mortgage unaffordability for Americans. So it's time to prioritize long-term economic stability over short-term political gains. According to Burry, a well-respected expert, we could be in for a bumpy ride in the second half of 2023. He predicts that the CPI could drop and the U.S. could fall into a recession, and if the Fed responds by cutting interest rates and the government stimulates the economy with more money printing, we could see another big inflation spike. It's a dire prediction, but it's not the first time we've heard it. The stock market has already crashed by 20%, and Burry believes we're only halfway there. He's even predicted that the S&P 500 could drop below its COVID lows. It's clear that he's very bearish for the next few years, and he's not alone. Many experts have lost confidence in the Federal Reserve and are concerned about the future of the U.S. economy. As we wrap up this discussion on Michael Burry's warning about huge inflation in 2023, we have to ask ourselves, what steps can we take to prepare for the potential economic challenges ahead? Let us know in the comments below what actions you're taking to safeguard your finances and investments against inflation. And don't forget to like and subscribe for more informative videos on the latest economic trends and insights.